Hey everyone, this is Joshua Martinez from Market Traders Institute. We're going to continue on our series of You Want to Be a Forex Trader. Now, our last presentation, our last video, we talked about where to find your broker, where to get your free demo charts, and as well as placing your first trade within 15 minutes. Now, one of the biggest mistakes that we see with new traders or traders in general who are trying to become investors are they have no plan. What's the old saying is fail to plan, plan to fail. And so what ends up happening, everybody has some sort of money set aside or some funds set aside, whether it's yours or whether it's somebody else's. And you want to see what kind of returns that you can get on your own in regards to you taking control and you learning how to trade versus just giving it to somebody. Okay, so let's run through some components. There's really three key factors in which you need to focus in on and you need to understand. You need to understand your risk percent per trade. Make a decision. How much percent do you want to risk per trade? Can you want to risk 0.5%, 1/4%, 1%, 5%? Just remember, the more you risk per trade, the less staying power you have. So for example, if you risk 5% per trade and you lose 20 trades, you lose all your money. It's very, very minimal drawdown there, or that's very minimal staying power. If you risk 1% per trade, you can lose 100 trades and then you lose all your money. And it's very minimal will you ever lose 100 trades in a row. So just kind of, food for thought. The second thing is, what is your reward percent per trade? If you risk $1, how much are you willing to make? $1? That's 1 to 1. Risk $1, make $2. $1, make $3. The more your reward per trade, the less you have to win. So for example, if you risk $1 to make $1, you have to win 6 out of 10 trades just to make a profit. But if you risk $1 to make $3, you just have to win 3 out of 10 to make a profit. There's much less involved as in winning requirement. Now, the third thing is win percent. Are you going to be a 30% winner, a 40% winner, a 50% winner, an 80% winner? That's going to come down to your ability and then your production. Okay, how many trades can you place per month? And so these are the 4 key things that you really need to focus in on. And these are the 4 things that many investors come to us and have us train them on how to trade the Forex market so they can lower the risk per trade, they can increase the reward, they can win more in percentage, and then get their production up to generate more money. Now let me give you an idea of what could be, okay? Now understand this, everybody's different out there and everyone has a different risk tolerance. What I'm going to show you doesn't necessarily mean that is for you. You could risk much more, you could risk much less. But let's just say, on average, you risk 1% per trade. So for every $10 you have, you risk 10 cents. You have $100, you risk $1 type of scenario. And then your reward will be 2% per trade. So it's a nice risk of 2 to 1. You lose $1, you win $2. You win twice as fast as you lose. And then you're going to win about 50%, which means for every 10 trades you place, you're going to lose 5. And production, most traders say that they can do, especially when they're new, they're very excited about this. They tend to place more trades up front, and then they realize, what they're capable of. Usually most traders say they risk or they trade about 1 or 2 times a day. Let's use the latter side. Let's just say you place 2 trades a day, 5 days a week is 10 trades, 4 weeks in a month. Let's say you place 40 trades. So 40 trades a month. So that would be the following. For every 10 trades you place, 10 trades, you're going to win 5 and you're going to lose 5 trades. You're going to gross gain 10%, you're going to gross lose 5%, and you're going to net a 5% growth for every 10 trades you place. Now again, This could be more, this could be less, depending on risk, reward, and win percentage. So keep that in mind of what you want to do. So this means for every 10 trades you place, 10 trades will equal 5% growth of your account, and 40 trades, what you can do 1 month, or 1 month is equal to a 20% growth or gain, okay? Now, we're not going to talk about compounding. If you want to learn a compounding technique, which is a very advanced way of trading, let me know in the comments below, and maybe we can create one of those videos. If you want to learn a strategy that can help you find a risk versus reward of $1 to $2 or 1% to 2%, I have another advanced way of doing so. You're going to see a link somewhere on this video or a link in the description that can bring you to that video, but that one's pretty cool. So 1 month equals a gain of 20%. Why? Let's refresh. Risk 1% to make 2%. Win half your trades, 40 trades in a month. 10 trades equals 5% growth. 1 month equals 20% growth. You place trades 12 months out of the year, so 12 months equals what? 12 months will equal 240% gain on whatever you have. Now, that is a monstrous gain, assuming that you win all 12 months. But let's be realistic. Realistically, you're going to win, if you do this right, you're going to win 10 months at 20% a month. You're going to lose 2 months, and let's just say you lose 20%. You go, if I lose 20% a month, I'm going to walk away. Okay, so at 20%, which realistically means 2 winning months will equal 2 winning months. So you basically have 4 months out of the year where you break even. That's very realistic when it comes to trading. So you basically have 8 months that you're profitable and you're generating money. The rest are break-even months. And so 8 months will equal a 160% gain on your money, which is very tangible and very realistic for many investors who do not compound and who take control of their own money. Usually a lot of like third-party brokers do obtain these types of results, but they kind of fee you to death, and their risk is a little bit lower as well. But they kind of feed you to death to where you don't see all of this gain. So they're keeping all the gains. So this is probably another one of the reasons why you're taking control. So let's just say that you have a $10,000 trading account, 1, 2, 3, and you get a 160% gain. You get a $16,000 US return. That is just over $2,000 a month on average, pretty decent. And you have an overall $26,000 in your account starting the following year, in which you can look to compound again. Now, once again, some investors will look at a 160% gain and say, that is way too much of a gain. It's way too aggressive. Some traders look at this and say, that's not enough. It really depends on how much money you have. Someone who has like $100,000 to trade with, $1 million to trade with, they're not going to risk 1% of their accounts, because if you have $100,000, you lose 1%, you're losing $1,000. They're not comfortable with that. But somebody who has like $10,000, they're willing to risk $100 because it's just $100. Because why? Someone who has $1 million, if they get a 30% gain in a year, that's $300,000. They can live off that, and it's sustainable income for them to retire, for them to travel, for them to compound and reinvest a few years. Someone who has $10,000, they only make $3,000. So they're going to trade a little bit different. So once again, you can manipulate this however you want. It really comes down to your ability. But risk percent per trade, reward percent per trade, win percent, how many trades can you win, and what is your production. And then you can kind of do your formula. Once again, if you would like to see a compounding way of equity management, let me know in the description. You can also follow me on YouTube as well as Facebook at www.facebook.com/FXPathfinder, and you can see like my Twitter stuff inside see those links in the description. This is Josh Martinez, Market Trades Institute.